Greetings, everyone. This is Eric Glazer, and welcome to Bright Spots in Healthcare, produced by Bright Spots Ventures. We are dedicated to accelerating innovation through content and communities and meaningful connections in healthcare. Our mission is quite simple. We want to bring to light what's working in our industry and help you determine how to scale it. And through our podcast, our private executive councils, our private events, and our overall go-to-market strategy work, we surface and amplify the bright spots in healthcare, those proven innovations others can learn from and replicate. Because at our core, we exist to foster trusted relationships that fuel real progress, because we believe the best way to improve healthcare is to find what's working and clone it. If you haven't subscribed to the show, please do so. Tell your friends. Bright Spots in Healthcare, wherever you listen to podcasts. Subscribe, leave a rating, and join our growing community of innovators and problem solvers. All right. When companies struggle, the instincts is to do more, right? More products, go to more markets, more initiatives. But sometimes a real breakthrough comes from doing less. And in the early 2000s, Lego was losing nearly $1 million a day. Leadership believed the problem was a lack of innovation. So guess what they did? They expanded aggressively. The theme parks, right? You've probably been to some of them. They went into media. They were just doing more increasingly complex things with their product lines. And the result wasn't momentum, it was chaos. And when Lego finally turned things around, it wasn't by adding more, it was by returning to the fundamentals. Fewer products, tighter focus, really disciplined execution, and overall just a much better understanding of what their customers actually valued. So the company didn't grow faster, it grew clear. And clarity created that momentum. And so that tension between motion and momentum, between that expansion and focus, it's something our guest today has seen up close across healthcare, media, law, and investing. Our guest is none other than Scott Becker. If you haven't heard of Scott, and my guess is you have in some shape or form, he is the founder and publisher of Beckers Healthcare, one of the most influential media platforms in our space. He's also a longtime partner at McGuire Woods, where he led the healthcare practice for more than a decade and worked closely and still works closely with private equity-backed healthcare organizations, navigating their growth, complexity, and regulation. He also hosts one of the leading podcasts in business. It's called Beckers Private Equity and Business Podcast. You definitely should check that one out. He speaks regularly with investors and operators about what's working, what's breaking across business, and more broadly. He has spent decades advising and investing in businesses, and has distilled those new lessons into a book that is going to drop this spring. It's already available on Amazon for pre-order. It's called Building Great Businesses, Create Momentum, Overcome Setbacks, and Scale with Confidence. And if that's not enough, in the mid-90s, he was privileged enough at my very first job. We're dating ourselves a bit here, Scott, to be one of my first speakers recruited at a conference company I was working for. So, Scott, welcome to Bright Spots in Healthcare.
Eric, it is an absolute pleasure to be with you. I love the framing of the discussion. The thing that you talked about, this sort of about with Lego and so forth, going broad versus going narrow, is one of the most interesting and challenging issues that founders and startup companies deal with. And it is a real challenge and an interesting discussion. So I just love that. Let me turn it to you, and then we'll talk about as broadly or whatever subjects you want to talk about. I'm so excited to visit with you, and thank you for having me.
It is. I'm psyched. We've been trying to do this for a little bit, so I'm psyched. I think, let's go with this. You see a lot of different founders out there. Healthcare. Let's talk to healthcare founders specifically, because that's the majority of the folks listening to this episode. What do you see as the hardest decision they're quietly wrestling with? Maybe one that's, we don't necessarily see from the outside. What's one that maybe isn't coming out loud and clear that we don't know and understand?
Yeah, no, I think there's 4 or 5. So I don't know if I could get down to one, but I do think there's this concept of, if you're a healthcare founder, you're in a race to get market share in a very, very crowded world. in a world where sales cycles are very challenging. And this becomes almost more complicated as you take in outside capital and you've brought in venture capital to fund you. So now you've got this race, and I've seen this upfront and closely in companies I've advised, invested in, and more, to grow at a pace that the venture capital fund wants you to grow at, and at the same time, actually keep on getting better and better at what you're doing. And so you end up in a spot where you're in a quick growth phase, you're hiring up on the engineering side, you're hiring up on the commercialization side, and you're trying to find product market fit and double down on it. And I love the discussion on point solutions versus broader solutions. We didn't even exactly call it that when you talked about Lego, but narrow versus broad. Because as you're building a company, as you're founding a company, almost everybody starts somehow or another with a point solution, something that they're really good at, that hopefully a system or a healthcare company or the ecosystem really needs, it can really use. And the challenge of building around a point solution, it's almost always hard to get started, is that sooner or later, your customers don't want to deal with 1,000 different point solutions. So you've got this constant chasm, this constant challenge and tension between being a point solution versus being broader in the health system and broader at what you do, even though you might have started with being just fantastically great at one thing. So when you mentioned Lego, getting into media, getting into parks, getting into 13 other things that some consultant probably told them was a good idea, the reality is there's a desire for that kind of growth, but then they end up not very good at all these other things. So this great challenge you have is almost all these companies are starting with a point solution. But for the long run, it's very hard to stay a point solution. And so it's a real tension with growth companies, with venture-backed companies, with founders, is how do you start with what you're great at and then figure out how you expand from there over time?
Yeah, I saw that from the first row. I spent just under 13 years at Teladoc, and I started that journey as part of Best Doctors, which was really the category creator for Second Opinion. And we knew we had to expand. And so we got into a marriage with Teladoc pretty early on in their maturation process. They were already public, but they were still relatively small. And that created this strategy around point solutions are eventually going to lose. And so everyone listening probably knows a little bit about the story, but in particular, the Livongo acquisition. And what we ended up finding, and I've been out of there just over a year, but what we ended up finding at times was now we went from being this really niche, trusted expert in a niche for a point solution, and let's say it's Second Opinion in telemedicine, maybe a little mental health in there too, but we started losing deals to specialized companies in cardiometabolic and diabetes, even though we had the category creator in Livongo, because we buried it into the Teladoc brand, and we weren't seen as expertise. Or same with mental health, we weren't seen as experts in mental health. So it's an incredible tough balance for founders, right? And so I'm curious because you mentioned this. I think you mentioned it's the sales cycles are challenging, and when you take on outside capital, now you've got this tug of war of long sales cycles and impatient venture capital. And I'm curious if you see any evolution of the market, the capital marketplace, and who's coming into healthcare and to invest in it. And do we have some smart, more patient, long-term investors coming in? And could that be part of the solution to the problem?
Yeah, I mean, I think you do, but I think it's all over the board. I was with the company yesterday that's founded or funded in part by people at Kleiner Perkins. And Kleiner Perkins, which is a great venture capital fund, tremendously successful. John Doerr's written a lot of books, Measure What Matters, brilliant person. And he's been in a lot of places a quite patient investor. And I think that's allowed companies to evolve and change and grow, knowing they've got a trusted partner that can work with them and develop and align. Some of the other venture capital funds are also really good at it. I remember investing a couple of years ago in a startup being funded by one of the big venture capital funds. I'm an investor with the fund. I'm an investor in some of their deals. And I couldn't understand the bet they were making. And so I had to talk to the one of the general partners at the fund and asked them, and she essentially said, look, this is a 10, 15-year bet. So like, I know we'd like to have you involved. We'd like to have you as an investor. And I'm not putting in money that makes a difference. Nobody needs the money. It's more so that I'm involved and have some advisory role and so forth. But it's a fascinating thing to me to think about it. Whatever age we are, we were doing business in the 90s. So we're not that young. We're not kids. And so you think about that, you're like, wow. So you really have to look at it and say, this is for them a long-term game of what they're trying to build here and become very substantial. And they, with another fund, made a huge bet in it. And it just is an absolutely fascinating mindset of timing and patience. And then I've seen other companies, one I served as an advisor to, was still growing at 40% a year. And at some point, they got sideways with their VC who thought that wasn't fast enough. And so, it's not, they're not, nobody's right or wrong, but there's a method to the VC game, which is you fund a company, you invest like crazy in it, you grow it as much as you can. And then when growth plateaus, then you find profitability. Then and I've seen this with lots of companies. One of them vividly, somebody called me, said, oh, they're laying off 200 people at a different company, totally different company. I was not an investor in. And they were like, they're so wrong. What are they doing? And I'm like, no, that's actually the design of what they're doing. They got to the growth plateau. Now they're going to make it profitable. They want to grow as big as they can, but now that they're only growing 20% a year, 10% a year, now they've got to make it a real company and get to the next spot of growth equity funding and figure out what they're doing with it, because it's now they've got to be profitable. And it's fascinating to see the different patience levels of different investors and how they look at things and how they work with them. Because obviously, I grew a business originally from scratch, and it built a couple businesses, and then been an advisor and investor in other businesses. And it's been a huge education for me in terms of how financing and investors, private equity and venture capital work and how they look at it versus how you look at it when you funded and bootstrapped at some point, which you understand as well. Yeah. Because if you're bootstrapping, you got to have cash flow at some point relatively quickly. If you're private equity funded, you better have cash flow. If you're venture capital funded, maybe not. Maybe you're growing first to grow into a certain size and become so big in your category and then become profitable. And sometimes we often talk about the 5 sort of stages of a company, from idea to product to revenue to profit to scale. And sometimes you reverse order on that scale and profit if you're funded as early stage or venture capital, versus if you're private equity funded or later stage, profits come before scale. I mean, it's an interesting dichotomy, but we find it fascinating to watch that difference. And the key for a founder is when you sign up with capital or you bring in capital, that you understand what the plan is and where you're at with people. And you hope that you've got investors that you're able to talk to and deal with, because there's going to be changes over time as well. And with patient, good investors, they're still going to want returns. They're still going to want things to work, but it's much easier to work through those conversations as you're making changes, you're making adjustments.
Do you think there's a take, what I've seen, and I'm looking at this from stance. I'm not deep in the expertise of this. Bright Spots is bootstrapped and will continue to be so. But the companies I work with and the CEOs that I get the privilege of collaborating with, I think it's an interesting dynamic when to take in money or take in another round, and when not to. And I've seen founders end up regretting taking too much money too soon, because of the dynamic you just described between sort of what the expectations are from investors. But I've also seen folks hold off, and because of that, fall behind and end up losing that way because they were a little bit too conservative. And do you have a little bit of, like, if you were to offer guidance to anyone who's thinking about, geez, should we do a Series A or a Series B or even taking money at all?
Yeah. No, we have that discussion all the time. And I think it's a really fascinating discussion. If you're bootstrapping, you could make it work. There are so many benefits financially and control-wise to be able to hold it for longer and not to bring in outside capital. There's just no way around that. But the flip side is, depending on what you're trying to build, that there are many types of businesses that people are trying to build that require a deep engineering team, a deep commercialization team, and it's almost not possible to bootstrap because just the needs are just too significant. And then it's trying to find good investors where if it works out how you want it to work out or anywhere near it, you still have a decent amount of input, a decent amount of control. You actually, what you don't want to do is build something worth $1 billion and make $300,000. You want to make sure that if you, and whatever the numbers are, it's a like so. But there's this real challenge, and sort of once you take an outside capital, it is never quite the same. And it doesn't mean it's bad. It doesn't mean it's good. But with so many of the things, like if I came from a bootstrapping era, so many things that people are trying to build today, you just really can't bootstrap them. Now, in contrast, I advise a consulting company, and they talk about should they bring an outside capital or not. And at the size they're at and what they're doing, I'd much rather they don't, because they don't need it. They're cash flowing, they're making money, they're making a living, they're growing. And once they're taking capital, they've changed their game, and they've often put a timeline on it too. So once you're taking capital, your investor typically has some timeline. It's not like they're investing with you side by side forever. They want an exit in 3 to 5 years, to 7 years, to 8 years, whatever the number is. And now you've changed the dynamic entirely, and you've given up a lot of control over your life. So where you can bootstrap, I love it. So many companies that are being built today, it's just not possible. So the economic needs to build the company and the race that you're in and to grow what you're trying to do don't allow it unless you're really willing to go slow over a long period of time. And the world is changing so quickly that people are scared to do that too.
Yeah, I'm gonna move us on. I just think the category of investment and investment strategy is one of the headwinds in our industry in healthcare, and it's just a fascinating one, and it's fascinating to hear you talk about it. We could do a whole episode just on investment strategy. I'm gonna move slightly on from that, but not entirely. Sure. The founders who now who have raised their capital, or even not, but they're under this incredible pressure to keep on moving. And so I want to talk about where the movement and the motion turns into noise, and sort of get into sort of the Lego story a bit, not specifically, but with the companies that you're familiar with and that you work with. So a lot of founders, I think, including yours truly from time to time, confuse motion with momentum. And I define sort of motion as activity that looks like progress, and momentum, this is right into Measure What Matters, by the way, and John Doerr, momentum is progress that keeps going even when you stop pushing, right? It's more tied to those KRs. So where do healthcare founders most often confuse motion with momentum, and maybe like where things look like they're gaining traction on the surface, but underneath, like, we got nothing really compounding?
Yeah, no, I think it's a great question. I mean, we used to use this phrase that, you got to dig 10 ditches before they start to dig themselves. I mean, you've got to make so much progress forward till you start to get real momentum. It's an old flywheel concept. It's an old concept. You really got to build something. Where I see sort of like, we used to always talk about founders that are playing business versus really being in business. Playing business is you develop nice decks, you're talking good, you're meeting lots of people, but the determinant is, the differentiator is, and we talked about this in this funnel concept we just talked about a moment ago, idea to product to revenues, is where you really start to see a difference is, one of the first conversations I have with founders is, are you actually seeing revenues or not? And what do those revenues look like? And even like a small amount of revenues is a big difference from idea to product to no revenues, because it means you've actually started to make sales and close sales and do business. And we talk sometimes then about false positives. People have had some early sales in an area, but they find the area is a really hard area to win it. So they've gotten some false positives that, this might be a winner, but it's not. And so when we see
some early upsets could trick the founders to thinking that they're in where they need to be in.
100%. As we got more sophisticated in this, and we have plenty of wins and losses, we look at it as, can you win in an area, and then is it worth winning in? So for example, and this is a great challenge, because if you're a founder, you can't be competing, for example, against NVIDIA. You probably can't be competing against Microsoft or Apple, but you might be able to compete in a very specific niche. where somebody needs you and you've got a great solution that they want. And then you have to make sure, is that niche big enough to create enough revenues to actually build an engineering team, a commercial team, and the rest of the team that you need to build to really grow a company. So I think it's a really, really challenging issue, and we see it a lot. And that's why, there's so many funded startups by venture capital funds, and a few percent really drive the big returns, the big numbers. It's not like it was at one time where if a venture fund funded 14 investments, 10 are going to fail, 2 are going to do okay, one's going to drive all the earnings. It's not quite as distorted as that, or as big a continuum as that, but it still is a situation where a handful of the investments are going to really make a difference in that portfolio. And when you see periodically companies that are funded, that are moving forward, but they're seeing really slow growth. They might be great engineering teams, but not great on commercialization. I mean, we see a lot of that, and then with the other thing you see that scares the heck out of you as an investor is what we call the big pivot. And you're gonna, this is gonna resonate with you because you've seen a lot of this. Is when somebody comes to you with one core concept: we're selling to this market, selling this software, this product, this whatever we're selling. And a couple years later, they say, we really think our market is this or not or that. And as an investor, when you hear that, you immediately think in your head, I can now dial this investment down to zero, because making a big pivot a few years in, tens of or hundreds of millions in, is a really hard thing to do. And it means they probably missed.
So I want to summarize what you just said, because I am probably misunderstanding two things that you said that seem to be in complete conflict with each other. So let me just repeat back what I heard high level, because you said a lot of really cool, interesting things. Playing business versus being in business. Okay. That's the first thing you said.
Yes.
You're just out there talking the talk and actually sell others that are actually selling product. And that gets to your concept of, and I maybe getting a little bit out of order, but idea to product to revenue to scale the profitability, or the profitability?
Right. So we always say there's five. There's a funnel of five. There's an idea, and there's a billion ideas out there. There's a small percentage that turns into a product. Then turning it to product is obviously positive, but product to sales is very different. So once you get sales, you're moving. Then there's this issue of, can you get big sales or can you get small sales? Then the fourth part of that funnel is profits, and then scale is fifth. But if you're in a venture capital funded company, it's more likely that you're going to reverse 4 and 5. Because venture capital,
I was half right. I'm going to take half credit then. I got the order right.
I think you were 90% right, quite frankly. It depends. If you're bootstrapped, profit comes before scale. If you're not bootstrapped, scale often comes before profit.
Okay, got it. So then you said something else, and you said something that was really interesting: the false positives, those early winners, those upsets that ask founders, CEOs, and investors that this could be a winner. So you said that, and I have a question about that, because then you went on to say you're nervous investors when they see the big pivot,
right?
They're writing it off. So I want to stay there. So how do entrepreneurs identify the false positive and identify it fast, and then what do they do? Because it sounds like, and maybe you mean you're going to have to pivot if you're smart enough to identify a false positive, you're going to have to pivot.
Sure,
but maybe it's not the pivot after X amount of fundraising. I don't know. Explain that for me.
Yeah, and so right, exactly. So a lot of it is early pivots versus huge pivots, and then throughout the course of a business, you're always going to be making pivots and adjustments. You're always discussing whatever service line you're growing into, whatever you're doing, wherever you're testing. There's so many concepts in this, but you're always going to be deciding, double down, pivot, or abandon. Are we doubling down in an area, or pivoting and abandoning an area? So like when you develop several different service lines as a founder, or several different product lines, you can periodically get false positives. Oh, we got some early revenues in that area, but that area is not that deep. So even though we got some early wins in that area, we'd be making a mistake, doubling down and tripling down and putting lots of resources and engineering into that area, because as hard as we push that area, there's only so much of a market in that area. The flip side is, when things are going well and you see an area and the area's got a lot of room to grow into, It's how do we allocate and stack resources around that area and put more and more resources into that area. Now, what I was talking about when I mentioned the big pivot, and I'll give two different examples of this without mentioning names. One of them is a company that was based on some kind of technology for monitoring. And 3 or 4 years later, they decided they want to be in a totally different industry to sell into for monitoring. And so when you're an investor in that, and you hear them come to you 3 or 4 years later and say, we spent 3 to 4 years really trying to sell into this area. Now we think we've got the answer. We're going into a totally different industry. As an investor, you think, oh, it's probably time for me to consider that investment to be shot, unless for some reason you have crazy confidence in the leadership team that they could do it. But it means that the original premise that you had all invested behind, that they're going to sell into one industry, is not working. And they probably don't know the other industry that well to domain expertise and really to be able to grow into the other industries. So that's one example. The second example is a similar example, but it played out in hundreds of millions of dollars and billions of dollars worth of investment by some people, was this concept of, we're really focused on this one market and what we're doing in this market. And a few years later, saying that market's not working, we have to pivot into a different market, into a totally different business market. And what happens when that happens is that just as an investor, you're listening, and it's always eye-opening for you, because you immediately think if they have to make that big a pivot, and these are not small pivots. And again, if you have big enough investors, patient of investors, then it could work sometimes. I've seen Bain Capital in different situations have tremendous conviction to an area. And so they keep on, and they've got the capital and the patience to make it work, to where sooner or later they make something work because they've got patient capital, clear capital, and they've got enough conviction on an area, they're going to make something work, when many of us thought, how are they going to possibly do that? But I do often see, you have to have an investor when somebody's making those kinds of pivots that's really patient and really confident and really has conviction around what you're doing. But typically when people are making big industry or market pivots, it's because it's not worked out the first time or what they're doing. And now as an investor standpoint, I always take it as though I'm losing my money in those investments.
Okay, so early pivots and small pivots, good, typically. Big pivots late or midway, bad.
I think that's a fair statement, and it's not. There's not a hard and fast rule on it. I know from my experience, when founders come to me or when their teams come to me and say, we've been at this for several years, we had one premise that you all invested on, now we're going into a different market, a different industry, and they haven't yet really grown out that other market or industry, I always view that as greatly concerning.
Okay, so let's kind of talk about when a founder mistakes sort of motion for momentum, right? That's how we started, how we got here.
Yes.
It often distorts what they spend time and their money on. So where do founders over optimize early, and what critical investments maybe do they usually delay, and then it ends up hurting them? Like, did you see some common mistakes there?
Yeah, I think what I see is the founding teams that I see that do just great are aligned founding teams where they've put together the founding team, typically with a couple founders that are very aligned, very much on the same page, personally, professionally, serious, good people, and they're really sort of good at what they're doing, and they build out a team. There's this great mix of urgency and intelligently onboarding and building a team. And we see so much of founders where they get so much pressure. Plus, once they've taken on serious outside capital to build a team really quickly and really build out those teams, and if they don't have a core nucleus that's really well honed together, then that could be a really difficult situation.
Right. So it's good. It's good to great to the T, right? Get the right person driving the bus, get some of the right people on the bus quickly.
I think that's right. And it often starts with a good nucleus. I've seen a couple situations where as they've grown and brought in other companies and consolidated, you need a CEO, a leader, a founder who's going to spend a lot of time literally in huddles and aligning that team so that they really stay on the same page. Particularly as you get funded in different ways, and the venture capital fund, the private equity fund has different ideas of how you got to fill the team out with a new chief sales officer, new chief commercial officer, new chief this officer, new chief that officer. The job of the CEO in constantly huddling and aligning with that team together and sorting that team out and seeing who's got what and how they contribute, it cannot be understated. It cannot be overstated. It is so important to get that right.
The over optimization, under investment dichotomy in your mind is that helps dictate the future success or failure of a startup is mainly around human resources and human investment is what you're saying.
I would say that's where I'm sure I'm not absolutely correct on this. It's where I've seen it the most. I've seen it the most where you've got a great nucleus of a team and they could take a lot of capital in because they've already got a great nucleus and build out and utilize that capital well. I've seen that work really well. The flip side is I've seen capital thrown at teams where the team is still relatively immature, doesn't have a deep team to start with, and they've had to add on a ton of different resources, and it's a scramble and it's chaos. And so I see that. I mean, you've got to build that core team out first to be able to build a much larger and broader team to really leverage it and really know what you're doing and what you're going after. And so, yeah, there's, I mean, a lot of other places that people could, I mean, you obviously have this situation with any startup company. They're almost always going to be too over-reliant on one set of customers or one or a few people. And we always, in terms of that customer vulnerability or fragility, the people vulnerability and fragility, we always talk about conjunctive and versus or. So like, you and I talk about sports often, does me no good to lose a great player to replace him with a great player. What I really need to do is keep the great player and add another great player. And similarly with when we see companies often, like a company I work with right now is way too over-reliant on one huge health system and fantastic, but they need a few more. But it would be a disaster to lose that health system and find a different health system as customers. That would be no good. But it's conjunctive. It's both. It's how do we get very deep with that health system and get very deep with a few more.
So God, could you provide, and please, obviously don't mention the company, but call them company X, maybe a company / team that maybe got their priorities backwards, and in retrospect they were backwards.
Where I see that most of the time is company X. There are so many people that have got excited about being founders, being investors, growing a company, but it really haven't really done it. And you've done it. So you understand how hard it is to actually get something started, get something going, build momentum. And so sometimes you could have, it's almost like they talk often about the consultant who took over Starbucks and had a disaster with it, and how much more positive it is now to have a leader at Starbucks that came from Chipotle that's really ran businesses. So what I see that goes wrong the most is people that are a ton of people are investing with them because they like them, because they're smart, but they really haven't built a business of seriousness from scratch. And it goes well sometimes. I don't see it go well often. I see it go much better when that founders actually started to build something before they've taken in money. So I see that. The flip side is some of the smartest people I've worked with, and they've been really educational to me, have been great at understanding. I'm a huge fan of many, many founders are scared to commercialize early. I'm a big fan, whatever you're doing, no matter how complex it is, you got to be talking to customers right away and early and often and testing with customers. And your friends who say it's a great idea, your colleagues that say it's a great idea, but don't actually buy from you are not real customers. So I'm a huge fan of people building out and really focusing first on their software teams, their engineering teams, and their commercialization teams. But the best founders that I've worked with understand scale in a way that I don't, where they're like, yes, Scott, but I also got to build out a couple of these support services to be able to really grow this and make this go. And that's part of working with some founders that are really bright at scale. which is different than I bootstrapped and grew to begin with.
So, you mentioned product market fit very early on, and I think that obviously distorts priorities as well. So, when you're looking at, and the dreaded P word, pilots, right, in our industry, especially when you're looking at pilots and early enthusiasm and how that could create a false sense of product market fit, right? Those false positives. Could you tell me about a time when a company may have thought they had product market fit and then they didn't, and maybe and then I have a follow up to that.
Yeah, I would say that probably there's probably so many of them, but the simplest ones for me are where I've started different things, and you could find some market, but you can't get deep in the market because you really haven't built out the team to do it, or that there's so much competition in that market. So I certainly have seen that a lot myself in terms of companies that I've worked with as advisors, as board members, and so forth. I mean, so many companies have tried to go into an adjacent area and not had success with it. I mean, they think it should be easy. And again, we're a huge fan of there's goodness gracious. I think it might have been from Bain Consulting as well. Guys that wrote a book, Adjacent to the Core, or Profit from the Core. And I'm a huge fan of generally building out things close to your core businesses, side by side with them. Next to them, you've got lots of synergies, you've got lots of customers, you've got lots of talent. But when I see people really struggle, it's because it's very much what you talked about, the Lego example. I love that example that you mentioned, Eric, is the example of somebody says like, well, we've seen all these other companies that have this, and then they've got this and this and that. So Lego thought they'd be like Disney. They've got one business, but then they'll have a product business and a parks business and a rec business. And they find it's much harder to do without having built it from a legacy standpoint to begin with. But we see a lot of that. I don't know that I've got. I mean, I've certainly seen it myself enough where we're chasing one niche and we shouldn't have been chasing that niche. Or we're chasing too broad a market and should have been chasing that market. I mean, I've seen that multiple times myself in different business iterations that we've had, and then we've had great success in a few businesses and not so much success in some others.
Let's talk about that because that's a great topic. By the way, Profit from the Core, a return to growth in turbulent times by Chris Zook and James Allen. We'll put it into the show notes. So
brilliant. It's one of the core books that we used in business over the years. I think brilliant writing. We've come back to it over the years. Might even have a copy here someplace, but brilliant people, brilliant thinkers.
I love good recommendations. I'm a big walker and listener, so I'm going to add that to my Audible portfolio. So I want to get into, we talked about like that early traction urge to kind of widen or maybe get away from the core. I haven't read the book, so here I use it already. But so I talk to me about, why does niche focus matter more in our industry in healthcare than maybe other sectors? And you alluded to the cost of whining too early, but maybe even if you had an example.
I think it matters in most businesses. I mean, in most businesses, if you're building, I've lived in building large law practice around healthcare and private equity, which really took off when some of my partners really drove it around that specific combination of things, not just private equity, which was clearly competitive, but healthcare and private equity. So they were really focused on a specific niche. And a couple of my partners built a huge business around healthcare and private equity and representing private equity funds that invest in healthcare. In the media business, we built originally 100 years ago around surgery centers. And very similar to what we're talking about now is, we couldn't build the size company we wanted just around surgery centers. And it wasn't size for size matters. It wasn't size because we wanted to make more money, God bless, but we had to be big enough and deep enough to hire great writers, to hire great conference producers, to hire great salespeople, to have a great commercial team, and to keep great people. And we 100 years ago looked at different media companies. Some were in 30 different verticals, some were in one vertical. And we made a decision we couldn't be in one vertical and build out the type of team and the size that we wanted to have and retain the type of people and grow the type of talent that we wanted. So we had expanded a long time ago into hospitals and health systems, into orthopedics and spine. And here's a great example of sort of no, I don't know if I'd call it false positives.
But you stayed close to your core there. It wasn't like you were going off and doing something in the airline aviation industry.
No, 100%. We stayed close to our core, and Profit from the Core was a part of this. When we originally put together our strategy for this literally 25 years ago, it was that we're going to be deep in 5 to 7 areas, not in 30 different areas. And we're in a lot more areas today. But the lesson we had was we were in the surgery center business to begin with. And the closest thing to the surgery center business was the orthopedic and spine business, because a lot of orthopedic and spine surgeons were investors and worked with and used surgery centers. So that was very close to surgery centers. Hospitals were viewed as a competitor to surgery centers. They sort of hated surgery centers and so forth. So we thought when we got going on this that all of our business growth would be in orthopedic and spine, and the hospital and health system thing was sort of a flyer. And it turned out, of course, 25 years later, that the hospital and health system part of our business and the health technology part of our business is 90% of the business. It's a huge part of the business.
Right.
And in hindsight, it's obvious. I mean, it's just a much bigger market. We're able to go very deep into it. There's just much more opportunity than there was in orthopedics and spine, than there was in a couple other areas. But we had some early sales in orthopedics and spine. Orthopedics and spine is still an important part of our company, but it's ultimately a small part of our entire company. We had early wins in it, and we would have thought, oh my God, this is where we're going. And within a couple of years, it was clear that the hospital and health system market in our business and hospital and health systems was dwarfing our business in surgery centers, orthopedics and spine. And so it was just, but there were so many different lessons there. One is that we couldn't be a point solution just in surgery centers because we couldn't build the size team, sales teams, events teams, editorial teams, that we wanted to have.
Is that what you were delivering? Just so we're clear, Scott, like you were delivering to them, this is the surgery and spine centers, you were delivering to them newsletters, publications, and events?
No, it was largely those things. I mean, it was largely those things, but it was newsletters, it was digital newsletters, it was events, and then the people that were paying for it, yes, there were registrants, but the people that were really making it go were advertisers and sponsors that needed to sell into those groups in those areas that needed to. So the whole idea was in the business to business media business, and you understand this, you've got two parts. You've got to have an audience, and then you've got to have somebody that wants to sell into that audience. You have to have sort of both. And so when we first had expand beyond a point solution, so when people have these discussions at venture capital funds and private equity funds about you can't be a point solution forever, I understood it implicitly, because we had that problem and I understood it. Like I just couldn't keep the talent I wanted to keep being just a small area. We needed a bigger company to be not as fragile and to be able to hire better and keep on growing. But yeah, there were so many lessons there. I'm sorry. Let me stop for a second, Eric, so I don't just talk. But it was a fascinating evolution. And then following what worked and doubling down, we're a big fan of we didn't know that hospitals, health systems would be 90% of our business, but we were at least smart enough to see these people are doing great. This area is going great. It's almost what you talk about, bright spots. This is going well. Don't fight it. Double and triple down on it because it's going well. And I'm a huge. We think about that focus that you think about. Great people. I've had great people with me for 25 years in the law firm, for 20 years in the media company. A lot of the same people. When you find great people, you double down on them. When you find great areas, you double down on them. Great customers, great niches, all those things.
Yeah. So if I'm hearing you correctly, in this example, you started off with a niche, you got traction. So check the box, you did the right thing there. You noticed that there was a ceiling to your growth in that niche. So you expanded out, you saw the adjacent or to your core, and now hospitals and health systems become your core. And then probably, and I don't know this for sure, but I think a lot of listeners know that you also have now a big payer business. So you probably established that and then went into another market that was tied to your core as well.
100%. No, right. We ended up now with a big chief payer summit or payer summit every year, and with a large health technology conference every year too.
Right.
But they were all expansions around adjacencies. And a lot of it goes into, testing and repeating and doubling down on what's working. So we also have a behavioral health summit, which has grown tremendously. We've got a chief pharmacy officer summit, which has gone fantastic, but they're all around the same umbrella and related people that we were talking to through all of our business areas. And a lot of the customers have to reach those various different areas. The flip side is, we thought, orthopedics and spine would be our home run. It ended up being a crazily competitive area. The people that spend huge amounts in orthopedic and spine spend it in a very narrow, different way. They don't spend enough for us to build a company around in the way that we do, at least not the size company we want to. Similarly, we have a huge dental business, which is great, but it's not as great as the hospital and health system or the payer business or the pharmacy business or all these other businesses. It's fine. I mean, we like it. It's interesting, but it's not nearly as substantial as some of these other areas.
Do you have an example, let's say, on the investment side? So if we leave Beckers and the media side of this for a moment, where you saw a tech company expands too quickly, and they don't want the end of the story is it doesn't have to be they went belly up. The Legos example, like, do you have another Legos?
Yeah, it's what happens is the challenge in the technology business is not a challenge. It's there's two different businesses. There's a software as a service business, which is ideally a really scalable business when it's going well, and then there's a consulting business. And some companies have to decide whether they want to be in the consulting business or they want to be in the software as a service business. And so I remember vividly working with a company, and it was a real lesson to me, is that the software as a service business was scalable and the margins are insane when it's going great. The consulting business is a human labor heavy business. And obviously there's great consulting businesses, but and there's obviously some incredibly big consulting businesses, but the consulting businesses that make the most money are also doing something on the product side or something on the CS side and so forth and so on. But it was a bad mix of businesses. They were far better off doubling and tripling down on the software as a service business, and their margins were fantastic. When they tried to get into related businesses, consulting type businesses, it was a debacle. And so we see that a lot. And just part of it's understanding the different margins in different businesses and can they coexist well? And you see that in lots of different worlds, where you might have different business that's synergistic, but the margins are so bad, it's hard to make that work and keep a team going. We have such different margins in different businesses that you have.
I'm sorry. So are you saying they should have never gotten into consulting? Because it seems like the big ones that I know really well, like ServiceNow and Oracle and Salesforce, they do both, right? And they've nailed both.
They do both, but they're playing a different game. And Oracle, like if you look at a company like Amazon, it's a great example of this different margin businesses. Everybody knows Amazon for the retail business, for what they built their business around. But 60% of the profits comes from their Amazon Web Services businesses, their AWS business. So it's like, and they have all the scale and all these different things, but the real profits come from AWS. And I don't know enough about the Oracle and the ServiceNows. What I know is the mid-sized companies, the smaller companies that were in one thing going great and had to figure out expansion, and they might have gotten big revenue expansion in some related areas, but the actual profits were horrendous. So we've seen that a lot.
Okay, that makes total sense. So let's close up here. I know it's getting late. If you zoom out a bit and we talk about, let's just talk about, I think a lot of this comes back to just discipline, right? Knowing to focus on, going back to measure what matters and how to go and how to resist that urge to sort of chase the short-term signals. So I guess I have a couple of questions I want to ask to end it. If a founder or an operator listening today made one better decision, let's say in 26, what decision matters the most? Is there something that, in your experience where you sit, whether it's through your show, where you have people on your show, whether it's through some of the investments you do, your law firm, like what's a decision that matters most to, let's say?
Sure. So I'm gonna give you another book because it's right on my bookshelf right here. So bear with me, Eric. Bear with me. I'm standing up for a second, but it's literally right here. So there is a book that I love, and there's a Peter Thiel book there too that I love too. But this is a book called The One Thing. I don't know if you've seen this before. The One Thing.
I've read it.
So you've read it. So what I love about this is, and I love your question about what's the one thing. For me, the one thing is often getting the people right. If I've got the right people on the team, there are so many things that we could do and do well. If I don't have the right people, and the reason I talk about the one thing is he talks vividly about dealing with a consultant, being underwater, being burnt out, and the consultant telling him, what you really got to do is get your department chairs, your leaders, your everybody's running everything. You got to get the right people in place if you really want to do this and do great with that. I always talk about the founder's evolution in 3 stages, and I don't want to go off on a tangent too much, but I talk about it very quickly in 3 stages. One stage is your cook, your bottle washer, all those things. The second stage, you've leveraged yourself, you've brought in people, but those people aren't necessarily great. The third stage is you've brought in people, and all those people can do what you used to do better than you could do it. And when you get to that third stage, that's when a business can move forward and move on and make the right grow traction without everything be dependent upon the founder's energy and drive. So I look at this, I always look at it as the most important thing I can do in almost any business is getting the people right. And then the other piece is, you have to be deeply involved enough, going back to measure what matters, to understand what moves the needle, what makes a difference. And so if I'm growing a company, marketing is important, but far more important is I got people actually in the field dealing with sales, dealing with customers, trying to produce revenues. And then the flip side is on the technology side, I'm not a technology expert, but I better make sure whatever I'm doing great and it's fantastic and actually easy to use. But I do think so much of it comes back to getting the right people in place to grow teams and do things. And then you need to understand as a founder, as a CEO, as a leader, what makes a difference? What moves your key performance issues? What makes a difference? What drives more sales? What causes growth? And what causes customer happiness? What leads customers to stay with you and get deeper and stickier with you?
I want to say it's Keller.
It is.
Gary Keller, maybe, but like that book, and it's been a while since I read it, but I think that it brought me back to, I want to make a point and make another book recommendation. The point, I've seen a lot of founders, and in truth, I probably still struggle with this from time to time too, where they're excited to build a business, they're excited about the vision and the mission and the purpose of the business. And then a year or 2, 3 later, they found that they've put themselves, and you mentioned the bottle washing and the 3 stages, they've put themselves in a job that they hate. And that leads really to the first, you hire that first set of people, and then you eventually get the people that do things better than you do. And I think that's a really important point. And that leads me to the book recommendation. So there's a book by Dan Sullivan and Dr. Benjamin Hardy. It's called 10 Times is Easier Than 2 Times. I don't know if you know it.
Yes. I'm an avid reader of his stuff. I love his readings. He's got another book called Who Not How, 10X versus 2X. I think he is, Dan's built that strategic coach thing. I tried it for a year. I didn't enjoy it. I was at a different spot in my career than most people in it were. So I didn't enjoy the actual strategic coach as much as I would have liked to. But what I did love was his writings and his thinkings. I think the stuff that he's written between him and Ben Hardy is really gifted, really insightful, easy to read, to the point, and makes tremendous sense. And I think you've nailed it, because we think a lot about that, the 10X versus 2X, what's trying to do.
Yeah, I mean, you mentioned it because I'm living through it. Like I had to, when I went full time into this venture, I had to basically repurpose my entire team to grow to that next level. And that's what 10X and 2X talks about is you got to grow in the scale. You ultimately have to put people in the different seats. And then, Who Not How and The Gap and the Gains, the other one, they're all great books. So boy, we'll put all these book recommendations in the show notes. Final question, and then we'll close up here, Scott. This is awesome. And I'm holding back. I'm being very disappointed not to give you a golf or football question. So where have you seen something very simply outperform, let me rephrase it. Where have you seen something that's just very simple outperform something that's far more sophisticated in healthcare? Is there advice you could give, in simplicity is the ultimate sophistication kind of mantra? Where have you seen something very simple where founders and operators here could like, wow, we got a Nero or we got a
Yeah, it's so funny. I don't know that I have a great answer to that right this moment. What I've seen is where I've been an investor, the best decisions I've made as an investor are where I'm investing consistently with the right people versus the right idea. And so, for example, um, it and this is not that's not a fair statement actually, because some of them are like people that were in great areas when those areas were great and investing side by side with them. So I can't think deeply enough about, is that the perfect technology or not? You know this because you see this all the time, and I see this all the time. People are constantly with me on, well, this is the perfect technology. This is great. This is that. This is going to be fantastic. And people want to show me their technology, and I can't judge their technology. I just can't do it. What I could judge is, am I investing in a company that Andreessen Horowitz is investing in, that General Counsel is investing in, that somebody else is investing in, that I trust their judgment a billion times more than me.
yeah.
You follow me? Like I just can't do it. 100 years ago, I did a lot of investing in healthcare, different types of facility businesses. And when it was going great, it was fantastic. But the smartest thing I did was invest side by side with people that really knew what they were doing, that were great operators. And I think
What made them great?
you know, what made them great? There were different things, and this goes. We had a discussion earlier today on macro markets versus micro markets. You go through different periods of time where certain businesses are just growth businesses, and they're easy businesses to invest in. And then you're investing in the business side by side with somebody who knows what they're really doing and continues to develop good returns, good management, good discipline. They're very good at it. Like we had a discussion today about with this concept of health systems in very difficult areas. If you're in a rural area, your macro environment is brutal, and it almost doesn't matter how good an operator you are. You follow me? Because
Yeah.
it's just you could do fine maybe, but it's really hard. There's not enough doctors, there's not enough physicians, there's not enough patients, there's not enough commercial patients. I talked to somebody yesterday who's in a state where they're 50th of 50 out of commercial insurance and Medicare insurance or Medicare reimbursement. It's just very hard to do really well in that. And you're competing for staff and physicians against people in other states where they can pay a lot better and much better standard of living and everything else. But so where it goes great is I'm investing with really bright people. I have some confidence that they're investing in the right market, the right areas. And that's about all I could do really, because I can't, I could judge the people I'm investing with. I can't judge deeply enough their investment thesis, and sometimes it's easy. Sometimes it's very clear to you, this is going great. And there's just so much opportunity here for the next X amount of years. And who knows after that?
So right people greater than the right idea. I guess the next episode we do is how do you identify the right people and know that the right people? Because sometimes you meet the wrong people.
I think right idea, right market, but it's like right technology is hard for me to judge. You're closer to technology often than I am because you were at Teladoc for a long time. Like I invested in a bunch of it, but I don't necessarily understand. I understand what I do understand is when health systems are actually saying, I want that technology, we're using that technology, and we keep on growing how much we're using your technology. Like I understand that.
Yeah.
But I don't necessarily understand how the technology
Got it.
really works that well.
Right.
But I understand, like when I talk to founders, as an advisor, as an investor, anything, one of the first questions I ask is, do you actually have revenues? Do you actually have customers? Because some people have an idea, and I don't have enough money or enough patience to invest in ideas versus do they actually have a product better than just an idea? Then do they actually have revenues? And those revenues, is there a pathway for those to grow beyond close relationships that they happen to be doing some early business with?
Right. So, but where I'm getting at, and you're talking a little bit more now as an investor than
Yeah.
founder, but it sounds like right people is
Yes.
and everything else. Then maybe having the right idea, the right markets next, and the tech should take care of itself, right? If you have the right idea, the right problem that you're solving, and you're in the right market, the tech will take care of itself most of the time.
I start with largely, do I want to have some money in that area? And I'm excited to invest with these people, with these investors, those. And then it is what it is. And I'm usually not making bets that cause me so much tension that it's going to cause a real, I'm obviously, did not grow up wealthy and worry much more about losing money than I do about making money, just as a general rule. So I'm usually putting investments in so I could ride alongside it, learn, be part of an ecosystem. I find it fascinating to invest with some of the people I invest with. Sometimes they go really well, sometimes they don't. But it's but I look at it first and foremost is am I investing with people that I trust their judgment? Do I trust them as operators or investors? And that's where I start. And then,
Okay. But it does sound like it would go back right people, right idea, right market. Then if you do all those things, you remember the right people leads with it, you should have
yes,
a solution in place and you have a much better chance of winning. I mean, those, if you don't think,
but I think that's exactly right, Eric. I think just to piggyback on that, if I've got the right people and the right market, the right tech, the right team, they will either win or they won't, or they'll lose. But if they lose, they'll lose because it just didn't work out, not because they didn't give it the right effort. So for example, if I have, you know, 20 salespeople at one of my companies, and two of the salespeople are just fantastic, and we're going after a new area, I'll know if that area is ripe or not because I put great people on it. You follow me? We could end up in a spot where if I'm investing in great founders and a great team, and they that will either work or not work because you're taking bets on often new technology, new markets. But if I'm with the right team, the right investors, I'll know it didn't work out, but not because not because we didn't give it the right effort.
makes sense. Right. It's going to maximize your opportunities to win that.
Yeah. As I invest in different things, when I've invested with a founder who's produced returns, I'm almost always going to reinvest with that founder. When I've invested with a founder and they've not gotten great returns, but they've made so much effort to make sure the investors get their money back, even though it's not turned out as they want to, just that kind of effort and diligence to try and make sure the investors are taken care of, fair enough. I'm likely to at least give those founders a second look as well.
Makes sense. Makes sense. You know, you brought up, you stoked another book for me, that I can make another book recommendation about because you mentioned about the customer too. I don't know if you're at Unreasonable Hospitality.
Yes, I've read it, and I got through 3/4 of it, maybe something like that. I love so much of it. I'm like, and he's great, and he's done an unbelievable job.
Real good there. I loved it. I
Yeah.
absolutely, I love because it's a restaurant book, but it's also about how to treat people and surprise them with great customer experience, right? So, but I think the one thing that came out in that book, and I did a little bit of my own secondary research after reading the book about just the Michelin star thing in general,
Yes.
is that these restaurants, they're not like awarded for like overall creativity and flair. They're awarded actually for consistency.
Yes.
So like these inspectors come back. It's not just like one time. They come back multiple times. They're looking for the same fundamentals, the quality, the execution, the reliability, right? Day after day and year after year, right? So I think when you're thinking about what we're talking about today, uh, and that's probably the most reliable, the most, I guess, biggest reminder, if we're going to summarize everything you just said for everyone listening, is it's like one brilliant meal doesn't earn a star. It's the sustained excellence that does, I would say. So great businesses, ones that are going to make it, aren't built on the occasional breakthrough or brilliant idea or the false positive. They're built on doing the fundamentals over and over again. And I think that's what makes the momentum.
And I think that is so right. In the technology world, we talk about Technology is a starting point, and it never has an ending point. So if you're building a technology solution of any sort, it has got to be endlessly, constantly getting better. It just constantly working closely with your customers, making sure you're debugging, you're improving, you're getting better, and it's forever. It's like the beauty of Apple is they're in their 17th operating system, whatever it is, but it's the same concept. Everything you do, it's why Epic has done so well. Is Judy Faulkner's run a team that constantly gets better. I mean, that constantly improves on what they're doing. And they start off often a minimal viable product in an area, then they get better and they get better, and it causes trouble for point solutions, quite frankly.
Well said. All right, there's a couple of I'm gonna leave it at that. That is a great bow on this. I want to thank everyone for listening. I hope that you take the ideas, extract some bright spots from this conversation from Scott, and apply them to what you're doing in your world, because that's how we make healthcare better for all of us. We produce this show for you. This is your Bright Spots in Healthcare podcast. Thanks, Scott. You're the man.
Thank you.